Hi, so today we're going to talk about the gold standard. A lot of us have heard about the gold standard. It's something people bring up, sometimes conservatives, often people on the right, not always, as a better monetary system, some way that would be more objective, more market based at managing our monetary system, something that would get rid of the Federal Reserve, something that would get the government out of the business of managing our money, something that would lead to prosperity and stability and free markets. Anyway, the gold standard. This is something, again, you probably perhaps have encountered, in political context. Judy Shelton, who is current nominee by President Trump to join the Board of Governors of the Federal Reserve, is a public advocate of the U.S. returning to the gold standard, and a fair number of people on the right share that view. So, but the gold standard is not just a more or less crankish political position that people hold today. It's a real important historical phenomenon. So that's what I want to talk about today. What was the gold standard? Well, the gold standard was essentially a way of organizing the international monetary system. There have been a few of these historically. The gold standard was the system that, in some sense, existed in its sort of pure form. Sometimes people talk about the classical gold standard, the high gold standard, between 1870 and 1914, those years being the Franco-Prussian War in the first case, and the outbreak of World War I in the second. After the Franco-Prussian War, Prussia, which was the dominant power in Germany, joined the gold standard officially, which was sort of, at that point, it was clearly the established monetary system in Europe. And World War I, of course, it all broke down. There was an attempt to restore it, not particularly successful after World War I. It broke down again in the 1930s during the Depression. And then, so if we're talking about the core of the gold standard being 1870 to 1914, a kind of not very successful restored gold standard between the world wars, we could then extend that forward in some sense to 1973, when the final sort of on paper link between the dollar and gold was broken, and backward to the 17th century, even earlier, because there's a long prehistory of gold playing an important role in European monetary systems. So, what defined the gold standard? What made the gold standard the gold standard? Well, fundamentally, it's the idea that money is linked to gold, that in some sense, anything that's serving as money, whether it's a checking account, whether it's a piece of paper currency, whether it's forms of payment that we don't really use today, like bills of exchange, that they all, in some sense, and I'm emphasizing in some sense, represent a certain quantity of gold. That behind any instrument that might be getting used as money, there is ultimately some gold backing it up. So fundamentally, money is linked to gold, which means credit is linked to gold. In some sense, you can't lend money unless you have access to gold, because it's not money. If it isn't backed by gold, if you don't have control over gold, you can't extend credit, which means ultimately that prices are linked to the availability of gold, and the level of economic activity in a country is linked to its supplies of gold. So it was an attempt not always successful, to link everything that we associate with money to this objective standard, the quantity of gold. And it also meant fundamentally that economies were linked to each other. And maybe this is even more fundamental than the gold itself, is the fact that under the gold standard, what happens to the monetary system, what happens to credit in the United States, Great Britain, and France, and Argentina, depends on what's happening in all of those other places. So, what concretely does this mean? Well, concretely, it means a few things. It means most we can sort of metaphorically, it means that money is gold. Gold is money. Well, in some times and places, gold coins have actually been used as money. People have made payments with physical gold. As far as I can tell, that case is actually quite rare and exceptional. Even when we're talking about the gold standard, it was a very, very small fraction of transactions that actually involved, bags of gold coins being handed from one person to another. That was never the norm, even under the gold standard. But in some sense, what you could say is the gold standard was an attempt to make the actual monetary system act as if that's what was happening. So, in some sense, the logic of the gold standard, if it's really being adhered to, is the logic of a system in which everything that people buy involves handing over precious metals to the seller. But concretely, what the gold standard meant was I would say 4 or 5 things. First of all, exchange rates were fixed to gold. The value of the dollar, the value of the pound, the value of the peso, the value of the franc, the value, whatever national currency you're talking about is defined in terms of a certain weight of gold. Every unit of that currency is a certain weight of gold. And these rates in terms of gold are supposed to be fixed, absolutely fixed. We sometimes talk today about fixed exchange rates as opposed to floating exchange rates, but there's always an understanding with a fixed exchange rate today that if circumstances require, the government can drop that peg or change it to something else. But under the gold standard, that option is not supposed to even exist. The value of a currency in terms of gold is supposed to have been fixed at some point in the past for all time and can never be changed. That is simply what that currency is. And it's really hard to exaggerate how strongly people in the era of the gold standard believed that this was an absolute moral obligation, that you absolutely could not, under any circumstances, violate the promise to redeem your currency in terms of the stated amount of gold. In the United States, in Great Britain, in France, in Germany, even in peripheral countries like Turkey or Argentina, although they couldn't actually achieve it, but it was widely believed that they should be trying to maintain this absolute promise to maintain the value of their currency in terms of gold. And obviously, this is a promise by the government, by the community to wealth holders. It's a commitment to the owners of money that their money can be taken out of that country and used anywhere else at the exact same value, at the value they expect it, the amount they expect it to be worth. Okay, so that's one. Exchange rates are fixed, really fixed in terms of gold. 2, you can exchange your money for gold at any time. So this isn't just a notional parity. It isn't just a notional value. You actually have the right to go to some office, whether, in some countries where you have a central bank, it's a central bank. In other cases, it's the mint or, the treasury, but there's some office where you literally can walk in, and if you have the currency of that country in your possession, you can trade it in for physical gold. This is what it means to be really adhering to the rules of the gold standard. And that's obviously how you make that fixed exchange rate actually meaningful, is by being willing at any time to trade either your currency for gold or gold for your currency at the stated rates. So that's 2. You can actually exchange currency for gold. And there's a lot of details about this. Where do you have to go and what are the terms? And, there may be some minimum amount, but in principle, you can make this trade either way at any time you want. The government is committed to doing that for you. 3, you can take the gold out of the country and take it anywhere else. This today is what we would call capital mobility, free capital mobility. If you are a wealth owner and you have your wealth in one country, you own a business, a plot of land, a stock, a bond, some other financial asset. It doesn't matter. You can, at any time, if you think the prospects are better somewhere else, you can sell your asset for the money of that country. You can sell your land, sell your business, sell your stock at a local currency. You take that currency to an office, you trade it for gold, and you take that gold anywhere else in the world that you want. This, again, is the promise that a country is making when it says that it adheres to the gold standard. That people not only are assured that the currency is worth a certain amount in gold, that's one, They're assured that they can actually acquire that gold in exchange for the currency, or the currency in exchange for the gold at that rate at any time. And they can then take that gold out of the country and go anywhere else that they want. So this, again, is a promise to wealth owners that they have sort of the free option of taking their wealth anywhere they want and taking it back anytime they want. This is a system that is designed to serve the needs of wealth owners and give them this guarantee that they can take their wealth across borders with perfect security. And finally, 4, that domestic, that is within the country's money creation or credit creation, is linked to the amount of gold in the country. Now, again, the sort of extreme case of this, which never existed, but it's useful for thinking about how the gold standard worked, would be if only gold circulates as money. Well, then obviously the amount of money in the country is just equal to the amount of gold in the country. If somebody takes gold out of the country, there's that much less money. And in that world where only gold is money, the only way to, there's not really credit at all, because the only way to lend gold is to first acquire the gold from somebody else. Some people imagine this is what the banking system actually looks like, that you deposit your money and then somebody else borrows the money. But the banking system has never looked like that. It certainly doesn't look like that today, but it also didn't look like that under the gold standard. A huge amount of money, even under the gold standard, was paper money, credit money. The gold standard doesn't preclude that. It was never an understanding that if you were on the gold standard, you had to literally forbid any other form of money from being used in your country except physical gold. No. Physical gold was only ever a very small fraction of money in circulation. But the key thing is that there's a fixed ratio, a fixed proportion between the money in circulation, the credit in circulation, and the amount of gold on hand, the amount of gold reserves that the central bank holds or that the banking system holds. And this is really supposed to hold for individual banks as well as for the country as a whole. If you're a bank somewhere, maybe in the United States, or a country bank in England or a provincial bank in France, how much lending can you do? Well, the amount is supposed to be in proportion to the amount of gold that you have in your vaults. You can lend more, maybe 10 times as much, but there has to be a proportion. At a certain point, you reach the limit. You can't lend anymore unless you can get somebody to deposit more gold with you. So this was supposed to essentially guarantee, on the one hand, that the country would actually be able to honor its promise to redeem its currency for gold. Because obviously, if you say, I'm going to redeem $1 for gold, anytime somebody brings $1 into the office, I'll give them the equivalent weight of gold, you can't create too many dollars, right? If you create too many dollars and then everybody brings them in at once, you won't have enough gold and you're going to break your promise. So the way that you guarantee that you'll actually be able to honor the promise is by not creating too many dollars. That's the commitment made by the country as a whole, and it's also supposed to be the commitment made by individual banks operating within the gold standard. So, how much can your bank lend? How many mortgages can they make? How many small business loans can they make? How much can they lend to the government? Well, it depends how much gold they've got sitting in their vaults. And how much gold do they have sitting in their vaults? It depends how much gold the world's wealthy people are willing to put there. Because again, they have the option at any time of taking their gold, taking their money, converting it to gold, and taking that gold anywhere else. So ultimately, the credit creation is taking place at any individual bank, in any region, any country, depends on how willing the world's wealthy are to leave their gold there. That's the logic of the gold standard. So in principle, it means that the whole economy of a country or of a region has to adapt itself to the preferences of wealth holders. If at one moment, investors, let's say foreign investors in Britain, are very confident in the prospects of Argentina, and this specific case is a real historical case that was quite important in this period, and they say, we're going to buy the bonds, maybe of the Argentine government, or we're going to invest in Argentine railroads. And that involves, in the first instance, sending gold to Argentina. Or actually, concretely, it meant just, gold that never actually physically left London was, credited to the government of Argentina. It was shifted to an account owned by the government of Argentina. But notionally, the gold went to Argentina. And now there's more gold available to back credit creation, monetary creation, money in Argentina. You get a boom in Argentina, suddenly it's easy to get a loan. Suddenly there's lots of money in circulation. It's very easy for businesses to get started. It's very easy for farmers to expand their production. Wages go up and everything's great until one day, for whatever reason, maybe a good legitimate reason, maybe just a rumor or something going on in some other part of the world that has nothing to do with Argentina, but for whatever reason, those investors say, I don't trust Argentina anymore as a safe store of my wealth. I'm going to turn my Argentine pesos back into gold and take it out. And suddenly, as the gold leaves, the whole process has to go into reverse. Banks have to call in their loans. You have to cancel out all that new currency in circulation. People who borrowed money can't pay it back. Businesses can't pay wages. Prices start to fall. Wages start to fall. And you get a crisis, a crash. Well, this happened repeatedly in Argentina. Now, in the case of Argentina, typically at that point, it turns out there wasn't enough gold to back all the money that was created. There wasn't enough gold in the bank's vaults to back up the credit they'd created, and so they're forced to suspend the gold standard. That happened repeatedly in Argentina and other countries in the periphery of the system. But they tried very hard to honor that promise, and in so trying, they basically made their own economy completely subject to the whims, or maybe in a more neutral term, the judgments of the owners of wealth all over the world. Because again, the central feature of the gold standard is this linking up of all the economies that are on it, because people who have the option, converting their wealth into gold, taking it here to there, to there, to there, at any time. And so what's happening in one place determines the availability of credit, the amount of money in circulation, the level of prices and wages everywhere else. So yeah, again, so this is the essence of the gold standard. This is the rules that have to be followed if you are on the gold standard. You have an exchange rate fixed to gold, never changes. 2, anybody who wants to at any time can exchange gold for your currency or your currency for gold at that fixed exchange rate. 2. 3, anybody who is in possession of gold can take it across your borders. You never impose any rules saying you can't take gold out of our country or you can't bring gold into our country, although there's no reason anybody ever would have done that in the first place. And then 4, you limit your creation of money, how much paper currency your government issues or how much paper currency you allow your banks to issue, because in this era, a lot of paper currency was issued by banks, how much lending you allow your banks to do. All that stuff is strictly limited by the amount of gold you are holding in reserve. Gold flows into the country, great. More money is available to borrow. Gold flows out of the country, no more lending and call in those old loans. So these, if you follow these 4 rules, you are on the gold standard. Now in practice, of course, some countries adhere to these things strictly, some less strictly. Every country, including Britain, including the United States, every country in severe national crises would suspend convertibility into gold. In severe national crises, they'd say, we need to make payments domestically, this is an emergency, and we cannot limit the amount of money we can pay to keep our factories running, to keep our soldiers paid, which is usually the nature of the crisis, based on the amount of gold we have. So during the Napoleonic Wars in Britain, for about 25 years, the United Kingdom suspended the gold standard. You couldn't convert a pound into gold. You couldn't take gold out of the country. But then they went back. The same thing in the US during the Civil War, suspended the gold standard, but then they went back. Typically, these returns to the gold standard were associated with severe deflation. In other words, falling prices. There was suddenly a lack of money in the economy, a lack of credit. Prices fell. But eventually, in the case of Britain after the Napoleonic Wars, the US after the Civil War, various other cases like that, the country was able to return to the gold standard at the old parity. The currency was returned to the same value in terms of gold. People had hoped to do that after World War I, but it was not possible for various reasons. The countries in general that returned to gold did so at a much, they had to set a new value, a new lower value of their currency in terms of gold. The United States being an exception there. And then, of course, nobody even tried after World War II, although there was a certain kind of gold standard restored after World War II. Nobody thought there was the remotest chance, and nobody thought it was even desirable to try to make a dollar, a pound, or a franc worth what it had been in terms of gold before the war. So I think I'll talk a little more in the next one of these lectures about the specific sort of economic theories around the gold standard and how economies were supposed to adjust under the gold standard, how this whole system was supposed to lead, because it was supposed to lead to balanced flows of trade, to a situation in which countries that maybe were importing more than they exported, there was some sort of natural adjustment process that would bring those flows back into balance. But again, I think I'll save that to my next lecture. But I want to make a more general sort of point here, which is that the broader thing that's going on with the gold standard, it's a kind of standardization. It's a kind of uniformity being imposed. This is what's different about maybe the high gold standard, the classical gold standard of the late 19th century versus earlier periods where gold or silver was used as a standard of value. In those earlier periods, there were national monetary standards that weren't necessarily consistent with each other, and it wasn't that big a deal. But under the real high gold standard, there was this very strong commitment to allowing money to flow across borders freely, to allow investment to flow across borders freely, to allow an absolute freedom. If you are a wealthy person sitting in London, you can invest your wealth in any country of the world, any respectable country, any civilized country, which means any country that adheres to the gold standard. You can invest. You can buy shares in an Argentine railroad. You can buy a Turkish government bond. You can, buy a stake in a Mexican cotton mill or whatever it is you want, and you are guaranteed. Obviously, the company may default. Well, that can happen. Maybe the stock doesn't pan out. That can happen. But the money you put in is guaranteed. The money itself is guaranteed to have the same value, the absolute same value. Your money that you put in will have the same value as the money you take out. That's the promise of the gold standard to you as a money owner. So it's creating this sort of assurance, which is really fundamental to allowing for this interlinked financial market connecting the world. I might have mentioned this before, but there's this funny thing about Adam Smith and the invisible hand, this phrase we've all heard. But if you go back and you look at the Wealth of Nations, what does he mean by the invisible hand? Well, the passage comes up in one, the phrase comes up in one specific passage, and he's talking about how wealth owners are not going to be willing to invest their wealth in businesses somewhere else because they won't trust the people in that country. They won't want to go themselves to have to oversee it because you prefer to live in your own country. They'll be worried about what will happen to their wealth if it's being invested maybe under a different set of laws by people they don't know, they can't trust, using a different kind of money. So therefore, out of their own self-interest, they will invest at home. And that's the specific context where he brings up the invisible hand. Well, that, in a way, maybe was a good description of the state of things in the late 18th century when Adam Smith was writing. But 100 years later, the gold standard was really an institutional innovation intended precisely to stop Adam Smith's invisible hand from operating in that specific context. In other words, to make wealth owners perfectly comfortable, turning wealth from one country to another country. You have a claim. I'm a British landowner. What do I own? Well, in the first instance, I get the rent from a particular plot of land. But now, I can maybe take out a mortgage on that land, so I turn that into money up front. And now I can turn my claim on this plot of land into a claim on a factory in that country, a claim on tax revenue over in that country, whatever I want to do. And I will get my money back just the same. It's just as reliable. It's just as safe. This was the thing the gold standard did. It was really a very difficult thing to do, to give people that faith. But then once you've done that, you created the possibility for this integrated international financial market. Now, as I've sort of alluded to, following the rules of the game, making that work, the costs of that on the periphery, on the countries on the edge of it, were much greater than on the countries in the center. In Britain, if the gold starts to flow out of the country, they can just raise interest rates a little bit. And all those people who are investing abroad will say, hey, higher interest rate at home, I'll bring my money back. It doesn't work that way in Argentina. If people are scared to invest in Argentina, raising the interest rates a little bit there is not going to change their mind. You can raise them a lot. You can engineer a deep depression in the economy, and you're probably still not going to be able to hold on to the gold. So at the periphery, it was extremely disruptive. At the center, it worked pretty well most of the time. But the key thing is that it was the absolute sort of precondition for a world in which you had foreign investment linking up all of these different places, because people aren't going to invest. They aren't going to put out money in the hopes of getting more money back unless the money they get back is equivalent to, reliably equivalent to the money they put out. And that was the fundamental promise that the gold standard made. So essentially, by subordinating real economies, by saying the amount of money that's available for paying wages, for buying stuff, for building things, all of that is going to be subordinated to the flows of gold in and out of your country. By creating all of this instability and insecurity for people in the real economy, you created this guarantee, this security for the owners of wealth that made them willing to commit their wealth all over the world, which was something really new in this period. So I'm going to stop there. And yes, next time we'll talk a little more about the economics of this, and then we'll talk a bit about the sort of broader issues of trade, and particularly the way in which sort of uniform commodities were fundamental to the development of trade in this period. All right.